Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence.
Markets are gradually stirring as activity picks up with the return of some participants post holiday, though updates remain limited and the quiet trend may continue for a few more days. Now, President elect Trump has kept the narrative alive with his active commentary on topics ranging from the Panama Canal to Canada, keeping the geopolitical discussions in play. On the data front, Tokyo's inflation accelerated for a second consecutive month in December, potentially increasing the odds of a rate hike by the BOJ in the near future. Good morning, JK. Now, the Boxing Day test seems to have started with a bang. What are your thoughts on the game and the markets as they come back to life?
Hey, good morning, Swaraj. Yes, we are in the last few days of the 2024 updates. And yes, as you said, the Boxing Day Test match has really been it's a match that has started with a lot of pace. I don't mean just the bowlers, even the batsmen. And I think how India plays in the first innings in this match will decide the fate of the series. The wicket is good, but I don't know. Looking at the way Indian batsmen have been faring, one has to keep their fingers crossed. Now, on the other front, on the news, we had mixed news. First of all, RIP for our former Prime Minister, Mr. Manmohan Singh, who is expired yesterday night, and big personality who started the process of reforms in India. And in other good news on the global front, Russian President Vladimir Putin is now ready for negotiations for ending the war, although he stopped short of agreeing for a ceasefire straight away. That's a good news on the global front. Now, on the economic side, there are two important numbers which I'm looking at. One is, as you rightly pointed out, the inflation number from the Tokyo region in Japan, and that's come higher than last month on the month-on-month number. And on the year-on-year basis, it's quite even higher. And this is again, as we have been saying, Tokyo region inflation is a precursor to the region, the entire country's inflation. And we know that last month's inflation in entire Japan was much higher than the previous month, as well as expectation. Even other numbers like industrial production and retail sales in Japan were, much better. We really cannot reconcile ourselves to Bank of Japan still maintaining, a stance that they need more time to hike rate. Although we know that the country, or rather the economy, is holding back because of the expected Trump policies. The other important data, of course, there have been very few in this holiday period, is the data from the US. While the weekly jobless claims for December 14 was lower at 219,000 previous week. What struck me was the continuing applications. That is, people who continue to receive benefits having lost their jobs and not finding a new one. That has increased to 1.91 million, and that's a high of of several months, or rather, I would say even several years, because that is a number that we should keep close track on. There are, even if the weekly numbers are lower, that means actually there are lesser number of job takers for, in the new job, or even a possibility that they are not eligible for the benefits. That's also possible. So there are technical factors that influence the weekly jobless claims, but the continuous jobless claim data is something that clearly indicates the job market is slowing in the US. So that is something that we should keep in mind, while we have most of the other data in the US pointing to expansion, good health. The job market is definitely something we should keep an eye on, because job market is also a leading indicator. Now, on the markets, there are two breakout. The US yields of the 10-year that broke to 4.64%, almost rising 10 basis points from where we closed before Christmas. And then, of course, it has headed down a bit after the claims data yesterday, and also a very strong 7-year paper that was auctioned by the US government. But the level at 4.64 is where we had seen it, May this year. And if you look at the chart, it does look like there is more upside for the yields. Fundamentally, because Fed is going to go slow on the rate hikes, and even the data, upcoming data, they are all quite strong except the labor market data. So that could, and add to that, the maximum funding that the government would be doing in the coming months for their deficit will also put pressure on the yield. So that's one breakout in the market. The other breakout has been the dollar index, which has broken the multi-month consolidation between 103 and 100, so now comfortably above 108. And with US yields having scope to rise much further, dollar index at 110 is very much on the cards. Now, what is leading the dollar surge is dollar yen, which is now closing in or trying to clearly break out 158. This is despite several increased warnings from the Bank of Japan officials. Euro USD, which is the bellwether for dollar's direction, is probably seeing short-term bounce due to month-end and year-end demand, and likely to see some more strength. But any level close to 1.0480, 1.05 will offer a good level for medium-term selling, because there is no fundamental strength that the euro is having to justify continued strength in the single currency. Among the Asian currencies, Korean won is the leading, is leading the weakness, having fallen now 13% from the low of September. Of course, driven more by domestic political factors, but that is keeping the sentiment low. Yuan holding around 7.30, continuously fixing the central rate at, which a huge difference to the market is actually keeping the so clear break of 7.3032 is not happening, so that's holding back. Now, coming to our own rupee, importantly, we had the RBI bulletin for October that was published a few days back, and the two important points that we note from there is that the RBI's intervention in the market has large sale of about $9 billion added in the overall head in the spot intervention, and stunning 59 billion of short position for the RBI. So the forward position is not included in the headline reserves. Therefore, the reserves which 2 billion is actually around 605 billion. So that's much, much less than what the market knows as the reserves. And then we also have heard about a very large position in the offshore market, which the RBI has been actively trying to contain the rupee weakness. So from the reserves point of view, why it is important is whether the RBI will continue to intervene in the same vein as they have been doing, and if they relent, you can see the rupee falling with a much more momentum. Another point that came from the bulletin was the RER, and which has gone to almost 107.20 from 105.34, which was there when the dollar hovering at the lower side. Now the dollar index and Chinese yuan both have risen substantially in the recent months, and that's India weakened only marginally, which has led to the RER being overvalued. So these two factors suggest that we have the rupee weakness is not going to end soon. If anything, we may see more momentum in the USD INR upside, at least in the new year, as we step into the new year. Of course, the last few days might be still related or still be guided by the flows. Wait for the new year to give some momentum to the USD INR direction is very clear. Only one piece of good news for India is that the government is now estimating economy to grow at 6.5% in real terms in this. And also there are pointers at the rural consumption and the urban consumption as per the high frequency data now showing some improvement. So this is giving rather a steadier growth. Just remember that we had a 5.4% growth that was reported for Q2 of FY25, but the government says that this is going to increase, and full year growth is going to be around 6.5%. That's a piece of good news. But that's medium term news, but I think no immediate relief for the rupee. So we'll have two more updates for this year before we wind up for 2024. Yeah, thank you.
Thank you, JK. And just quickly summarizing, Tokyo inflation was higher both month on month and year on year. Now, Tokyo inflation is known to be the leading indicator of inflation in Japan as a whole. And even their retail sales and industrial production data was good. So, all eyes on BOJ, whether they hike or not, or data suggests that they should be hiking considering the state of the economy. So, that's something markets will be closely following in January. Now, the weekly jobless claims headline number was lower, but the details show a mixed picture, especially since the continuing claims are clearly showing that the U.S. job market is slowing. So that's another possible labor market narrative which markets will follow on into the next year. When it comes to the markets, the 10-year yield has been continuously rising. It rose to 4.64%, a level which was seen in May 2024. And as JK mentioned, there may be more upside for the yields considering the Fed may go slow on the rate cuts. The dollar index continues to trade comfortably above 108, and if this continues, it may lead to a rally towards 110. And even in the Asian pack, this dollar strength was evident. Korean won leading the depreciation against the USD. They have their own political turmoil which is going on. Yuan is holding around 7.30. And interestingly, when it comes to rupee, we have been hitting all-time lows. But at the same time, interestingly, the RBI bulletin was published a few days back, and as JK mentioned, the intervention figures are quite large. So that's sort of concerning. REER has also gone to 107 from 105, shows rupee being overvalued, considering that rupee has depreciated in a limited manner compared to how DXY and CNH have moved. That's it from us today. Thanks for listening. Have a very good weekend, and we'll see you all on Monday with a fresh round of updates.